All right, let's talk HSBC. Their latest earnings report, honestly, it looked kind of messy. You see this big headline profit drop and you think, uh-oh, but then the stock price went up. So what's the deal? Today, we're going to break down exactly why the market tuned out the bad news and what that means for the stock. So here's the game plan. We'll start with those two headline numbers that seem to contradict each other. Then we're going to dig in and separate what's real from what's just, well, noise. We'll get into management's guidance, see how the market took the news, and then at the end, I'll give you our take on the whole thing. Okay, let's jump right in. HSBC's results were basically a tale of two numbers. One of them looked pretty bad, but the other, it suggested the bank is absolutely crushing it. So let's figure out what's really going on. Okay, first up, the good news. If you ignore all the weird one-time stuff, the bank actually delivered a really solid beat. We're talking adjusted earnings per share, that's EPS, of $1.80. Wall Street was only looking for $1.65. So operationally, yeah, that's a clean win. But, and this is a big but, here's the other number. The official by-the-book profit before tax was down. A lot. We're talking a drop of 14% from last year. So what gives, right? How can you beat expectations but also shrink? To get that, we've got to go a little deeper. And that's exactly what we're going to do now. It's time to peel back the layers and figure out what's the real signal here versus all the distracting noise. Okay, this is it. This is the key to the whole quarter. That huge gap between the strong results and the weak reported profit, it all comes down to one thing, a massive $1.4 billion charge for old legal issues. Think of it like setting money aside to pay for stuff that happened years ago, like the old Madoff case. This is all about the past. It tells you nothing about how the bank is doing today. Because once you push those legal charges aside, man, the core business looks powerful. Net interest income, that's basically the profit they make on loans, it was up a huge 15%. Their wealth management business, fees were up 29%. And their capital buffer, this thing called the CET1 ratio, is rock solid at 14.5%. That's way more than they need to have. And you know, this is exactly what the CFO, Pam Cower, was hammering home on the earnings call. Her message was super clear. Hey, our strategy to simplify this bank and focus on what we're good at, it's working. The momentum is absolutely real. And all that underlying strength gave management the confidence to talk about the future. And this, right here, is where the story gets really interesting for investors. They weren't just defending the past quarter. They were actively raising expectations for what's coming next. So get this, they bumped up their full-year forecast for net interest income to $43 billion or better. That's a billion-dollar raise. They also said profitability, measured by a key metric called RoTE, is going to be in the mid-teens or better. And they're doing all this while keeping a tight lid on costs. You just don't do that unless you're feeling really, really confident. And that confidence isn't just talk. It's backed up by some seriously aggressive moves. Just this quarter, they announced they're getting out of retail banking in Malta and Sri Lanka. That makes a total of 11 market exits this year alone. They are being absolutely ruthless about cutting businesses that aren't working so they can pour that money into the ones that are. Okay, so let's recap. On one side, you have that ugly headline profit number. On the other, you have this story of strong growth and management raising the bar for the future. So, which story did the market believe? Well, the market didn't hesitate. The verdict was swift. As soon as traders in London got a look at the details, the stock jumped almost 3%. You know, money talks, and in this case, it was shouting that it believed the good news. It really shows you what investors chose to focus on, right? They completely looked past the noise, that reported profit miss, the old legal stuff. Instead, they locked onto the signal, that powerful growth, the upgraded guidance, and that fantastic momentum in the wealth business. All right, so let's put all the pieces together. Now it's time for our take here at Talk Tickers, our rating and why we think what we think. So the big question now, the one that really matters for anyone invested, is can this momentum keep going? Was the market right to be so optimistic? And what does it all mean for the stock price from here on out? After digging through everything this quarter, we're initiating our rating on HSBC as an outperform. We think the market got it right. They saw the real strength under the hood. And frankly, we believe this stock has more room to run. And our outperform call is built on 4 main points. First, those interest income numbers should stay strong, especially since it looks like rate cuts are getting pushed further out. Second, that momentum in their wealth business is the real deal. Third,
management's plan to hit that mid-teens profitability target, it looks totally credible. And last, the way the market reacted tells you that other investors are also focused on the right things, which is always a good sign.
So, to sum it all up, HSBC's quarter was noisy, no doubt about it. But the signal, the real story of underlying strength and future growth, that came through loud and clear. Now, it's all about execution. And of course, just a reminder, this is our analysis. It is not financial advice.